Dipula has posted a near 5% dip in half-year distributable earnings per share. The firm believes that market conditions for the rest of this financial year will be stable. Given this, the board anticipates that distributable earnings per share for the second half will be in line with the current period. And joining me for a closer look at what's playing itself out in that company is company CEO Izak Peterson. Mr. Peterson, an absolute pleasure. Good afternoon to you.
Good afternoon.
All right, keen to maybe start off by looking at, the period in review from rental growth, looking maybe even at the property type mix that we are seeing in that rental growth line.
Right. On the period basis, our portfolio remained more or less the same in terms of the split between the various asset classes. But I mean, retail is still by far our largest exposure within the portfolio. We have some, more than 60% exposure to retail, about 64%, both in terms of, the space under management as well as revenue. We've seen some really good numbers come out of that retail segment during this period. Our turnovers grew by about 14% year on year. And basically that particular portfolio also showed the most resilience in terms of just the income growth that we that it yielded during the period. I believe that obviously that we hold a defensive portfolio in terms of just the market segments that we cover. I mean, that market segment seems to be far less sensitive to higher interest rates than your upper end of the market. And yes, as I said, I think our retailers are reporting very good numbers from that point of view.
I'm also keen to get more insights on rental reversions over this period and how that's also an important metrics in understanding how the business fared.
So we've had some positive rental reversions on the retail side, and we've had a slightly negative reversion on the industrial side, and we've had a fairly large negative reversion on the office portfolio. And that came from us renewing a lot of our government leases during this period under review. The office portfolio is only about 15% of our exposure. So if you look at that number, I mean, on a standalone basis, it looks like quite a scary number, but I mean, it doesn't really impact the numbers because our exposures is the least in that subsector. But I think what investors in Dipula can now enjoy going forward is stability. We've renewed almost 80% of all the office renewals that are due in 2024 in the first half of this year already. So I'm very confident that in the second year we'll renew the remaining 20% in that sector, and then we'll have stability now for the next 5 years or so. So as I said, I think given the defensive mix and the fact that the anchor of the portfolio being retail is performing as well as it's doing, we got room to play around to the other subsectors. The other interesting sector in terms of contribution during this period is that our residential, which is the smallest of the sectors that we cover, actually contributed 1% more than the prior year to both net income and gross income during this period, and that's on the back of very healthy growth in rentals of up to 8% in that affordable housing space.
What we also do know, Izak, at this point is that, Dipula is completely South Africa facing, and you've really, in the past reiterated that this is a commitment that you've made. But I'm keen to find out then how service delivery, energy issues, even water issues might be playing themselves out as a result.
I think it's a foregone conclusion that, energy will continue to go up at very steep levels, for the short to medium term. I don't know what's going to happen long term though, but I mean there are sort of positive signs from that side. But what we did see during these past 6 months is that double-digit growth in electricity costs came through from the various municipalities. I mean those numbers were quite steep. I mean in some municipalities that number went as high as 20%. And the good news obviously in this period was that if you look at relative load shedding levels to the prior period, that was lower. And therefore, I mean, that diesel price is normally much more than the electricity price. So that was a bit of relief, to our tenants in that, and in that we also saved another sort of 20% in our net cost line related to diesel as a result of a lower load shedding. But Dipula is rolling out some solar on its portfolio. We've committed to about 50 million just for this period that we're talking about, to spend on solar, and that's about 5.3 kilowatt peak in electricity. I mean, that will take our solar production fourfold up to where we are now at the moment. And then we're looking at in the next 18 to about 36 months to roll out about 3 times that level.
I also want to chat on, anchor tenants here. I think, in the retail sector, a very important part of the Dipula business. If you are seeing a diversification in anchor tenants there, but also how relationships are going, considering that a lot of the retail sector at this point is also under quite a bit of pressure.
Yes, look, I think we've got amazing operators in retail in South Africa. I mean, firstly, I think you'll struggle to find places in the world where these retailers understand the market as well as they do. I think our retailers obviously also always uncovering new markets. I think if we compare retail to say 20 years ago in South Africa, I mean, retailers have gone into markets where historically they hadn't gone in. And that market just keeps changing in terms of how people relate to retail and how it actually happens. I mean, the amount of retail space in the more dense parts of the country is still quite low compared to sort of your sort of more suburbia net. So retailers are going there, getting closer to the customer, and they're capturing quite a big part of that informal market check that's also coming through there. I believe that retail will be underpinned quite nicely, especially in those markets going forward. I was just saying to someone earlier, and I think some of this two-pot pension fund withdrawals that's been introduced, I mean, quite a fair chunk of that is probably going to end up in retail and to some extent, probably mostly in our retail segment that we're covering in a lower LSMs.
Thank you so much for that, Izak. It's been a pleasure hearing from you. Thank you so much for taking us through the set of numbers. That was Izak Peterson. He is the CEO there at Dipula Income Fund.